On January 28, 2026, gold hit $5,589 per ounce, the highest price ever recorded in the history of the metal.
The value of gold rise to a record high this week.
Gold.
Then it crashed. By mid-March, gold had fallen from $5,589 to approximately $4,550, a drop of nearly 19% in 6 weeks. Its worst correction in years. And every financial headline started asking the same question. Is the gold rally over? Here is the answer, and it is not what most people expected. To understand what happened, you need to understand why gold hit $5,589 in the first place. Because it was not an accident, and it was not a bubble. It was the result of 5 structural forces that have been building for years, all hitting their peak at the same moment. When you understand those 5 forces, the crash starts to look like something completely different. It starts to look like an opportunity that the smartest money in the world just used. Gold is not an investment in the traditional sense. It does not pay dividends. It does not generate earnings. It does not build products or employ people. Gold is a signal. When gold rises persistently and dramatically, it is telling you something about the confidence that the world's largest institutions have in everything else. For most of the post-war era, that confidence was high. The dollar was the world's reserve currency. U.S. treasuries were the world's safe asset. And gold was something your grandmother kept in a drawer. That world is changing. Central banks bought 863 tons of gold in 2025, below the 1,000-ton threshold of the 3 years before, but still the 4th highest annual total in recorded history, and far above the long-term average of 473 tons per year. World Gold Council, 2026. For the first time in decades, the market value of gold held by foreign central banks has overtaken their holdings of U.S. treasuries. IMF data, 2026. The institutions that manage the world's money now hold more value in gold than in American government debt. That shift did not happen by accident. It has been building for years. In January 2026 was the moment it became impossible to ignore. The last time gold performed anything like this was 1979. In 1979, the United States faced a specific combination of conditions that gold thrives in. High inflation, stagnant growth, an oil price shock, a Federal Reserve caught between 2 impossible choices. That combination has a name: stagflation. In early 2026, every major indicator was pointing in the same direction. U.S. inflation running above target. The Federal Reserve holding rates at 3.5 to 3.75% because cutting would reignite inflation, but holding them is slowing growth. Federal Reserve, January 2026. This is the stagflationary trap, and gold is the historically validated response. In the 1970s, gold rose approximately 20 times from its prior low. The current rally from $2,624 in early 2025 to $5,589 in January 2026 was a 113% gain in 12 months. Even after the March correction, gold is still up over 75% in a year. Goldman Sachs maintains its year-end target of $5,400. JP Morgan stands at $6,300. Deutsche Bank at $6,000. Goldman is currently the most conservative forecast on Wall Street. Goldman Sachs Research / JP Morgan, April 2026. When a most conservative bank on Wall Street is calling $5,400 after a 19% crash, the signal is hard to dismiss. Since 2022, the world's central banks have been quietly reducing their dependence on the US dollar. The trigger was the freezing of Russian foreign reserves after the invasion of Ukraine. In February 2022, the United States and its allies froze approximately $300 billion in Russian central bank assets held in Western institutions. Every central bank in every country that is not a close American ally watched that happen and drew the same conclusion. Dollar reserves can be weaponized. Dollar assets can be frozen. Dollar dependence is a strategic vulnerability. The response was structural. China has officially increased its gold reserves for 14 consecutive months. Poland, the Czech Republic, Brazil, Malaysia, South Korea, sovereign buyers inactive for years return to the market. World Gold Council, 2026. These are not speculative trades. These are decisions about what to hold when you no longer fully trust the currency at the center of the global financial system. There is a number every central bank is watching. $36 trillion. The current accumulated debt of the United States government. The United States now pays over $1 trillion per year in interest on that debt alone, more than its entire defense budget. Moody's downgraded the U.S. credit rating, the last unvarnished top-tier rating gone. When the world's largest economy cannot service its debt without printing money or borrowing more, the value of that economy's currency comes into question. And when a currency comes into question, gold goes up. Not because gold is valuable, because the alternative is becoming less so. But none of this explains why gold crashed 19% in the same period it hit a record high. And the answer to that question is the most important part of this entire story. Then came February 28th. The United States and Israel launched joint airstrikes on Iran, assassinating Supreme Leader Ali Khamenei in an operation codenamed Operation Epic Fury. Iran closed the Strait of Hormuz. Brent crude crossed $100 per barrel. Wikipedia, Economic Impact of the 2026 Iran War. JP Morgan Global Research, March 2026. Every major conflict in modern history has been accompanied by a gold rally. Not because gold has anything to do with war, but because war creates precisely the uncertainty that makes gold attractive as a safe haven. Oil shocks add inflation. Inflation reduces the real value of cash. Reduced real value of cash increases demand for gold. The transmission mechanism is direct, fast, and historically consistent. And then there is the most uncomfortable driver of all. In 2026, the independence of the Federal Reserve is under direct political pressure. President Trump has repeatedly and publicly threatened to replace Fed Chair Jerome Powell. Federal prosecutors opened an investigation into Powell, which Powell called a pretext to gain political control over interest rate decisions. The Federal Reserve's credibility rests entirely on one premise: that its decisions are made on economic grounds alone, not political ones. When that premise is questioned publicly by the president, something shifts. The institutions managing trillions in reserves start asking a question they have never asked before. If the Fed is politicized, what happens to the dollar? Gold does not have a chairman. Gold cannot be pressured. Gold cannot be printed. In 2026, that is starting to look less like a limitation and more like a feature. 5 structural forces, all real, all running simultaneously. So why did gold crash 19% from its January peak? Gold is not just a safe haven. It is also one of the most liquid assets in the world. When markets turn volatile, when stocks fall, when margin calls hit leveraged portfolios, institutional investors sell what they can sell fast. Gold trades 24 hours a day in every time zone with deep markets and tight spreads. So when a fund needs cash, gold is one of the first things that gets sold. Not because it has lost its value, but because it is the easiest thing to liquidate. March 2026 brought a wave of broader market stress. A Fed that signaled fewer rate cuts. Oil above $100 fanning inflation fears. A dollar strengthening as capital fled to safety. Institutions deleveraged, and gold went with everything else. So here is the real question. Not where gold has been, but what the 3 numbers you need to watch right now are already telling you about where it's going. First, the U.S. 10-year real yield. Nominal yield minus inflation. With nominal yields around 4.4% and inflation still running hot, real yields are near zero. When real yields are zero or negative, gold has no opportunity cost. You give up nothing by holding it instead of a government bond. A sustained move above 1.5% to 2% real yield would signal genuine pressure on gold. Until then, the floor holds. Second, central bank purchasing pace. Published monthly by the World Gold Council. Currently running at approximately 60 tons per month. Goldman Sachs Research, 2026. If that pace drops significantly, the structural floor under gold is weakening. If it holds, the story is intact. Third, the USD/gold correlation. Normally, dollar up means gold down. But in early 2026, gold was rising alongside a relatively strong dollar. That means the demand was structural, not just a reaction to dollar weakness. Watch for that to reassert itself. If gold holds even as the dollar strengthens, the structural buyers are still in. If gold starts falling every time the dollar rises, the structural case is weakening. These three numbers will tell you what is happening before any analyst does. Gold hit $5,589 in January 2026. Then fell 19%. Goldman Sachs did not change its target. JP Morgan did not change its target. Neither did Deutsche Bank. And the central banks, sovereign wealth funds, and long-term institutions that understand what gold is actually telling them use that correction to accumulate more. The five forces, stagflation, de-dollarization, U.S. debt, Middle East conflict, and eroding institutional trust, did not disappear because the price dropped. They paused, briefly, while the smart money repositioned. Gold is not predicting a crash. It is not predicting a collapse. It is telling you that the world's largest institutions are quietly, deliberately moving a portion of their trust out of paper promises into something that has held its value for 5,000 years. Whether that is rational depends on one question. Do you think the institutions managing the global financial system know something the rest of us don't? Given what they did during the March correction, they might. If you want to understand the economics behind the headlines, subscribe to The Econaut. The link is below.